And again, we're talking about financial statement analysis here. As a student, you should understand that there are really 4 different types of financial ratios: liquidity ratios, leverage ratios, activity ratios, and profitability ratios. Now, we're also going to talk about a type called investment-based ratios. Technically, those aren't financial ratios. Financial ratios get all of their inputs from the financial statements of the company. Investment ratios, you need the price of the stock in the market for those, and the price of the stock in the market is not on financial ratios. But there are 4 types of financial ratios now: liquidity, leverage, activity, and profitability. As a student now, you should remember what the definition of each of those is for, because they'll help you explain the ratios. A lot of people that hire business students will tell me that, they can generate a lot of numbers, but they can't explain the numbers. It's important that when you get out and practice that you can explain these numbers so that people understand. Liquidity ratios, for instance, they measure the firm's ability to meet its short-term indebtedness. All liquidity ratios measure that. Leverage ratios measure the extent to which the firm is financed by debt. Activity ratios measure how effectively the firm is utilizing its resources. And profitability ratios measure the performance of the company. So it's important for you to remember the definition of each type of ratio that we go over here, because it's going to help you to explain this kind of thing to your boss or your client, maybe on an exam even. Now, the first type we're going to talk about now are liquidity ratios. And again, liquidity ratios measure the firm's ability to meet its short-term indebtedness. As we're going to do as we go through all these different ratios now, as we talk about the components of the ratios, we're going to kind of block off on the financial statements what it is that ratio looks at. And when we get all through with this, with the 14 or so ratios, you're going to find that almost everything on the financial statements have been touched, have been explained by these financial ratios. Just so you know, there are hundreds of different types of financial ratios. Depending upon the industry you're in, that's going to drive what ratios you use. So whatever industry you're working in, you need to find the ratios typical for that industry. But no matter which ones you collect now, they're either going to be liquidity, leverage, activity, or profitability ratios. Again, important that you remember those, and important that you remember the definition of the various ratios. Now, liquidity ratios. Again, they measure the firm's ability to meet its short-term indebtedness. Probably one of the best known liquidity ratios now is called the current ratio. And the current ratio is defined as the current assets divided by current liabilities. So on the balance sheet, we're talking about this number right here divided by this number right here. Now, current assets and current liabilities. Liquidity ratios kind of look at the firm's ability to meet its short-term indebtedness. That's current liabilities, by the way. Current indebtedness, current liabilities, same thing. It kind of looks at the worst-case scenario. That is, if the company went bankrupt, how would the company pay its short-term indebtedness? Long story short, in bankruptcy, you would liquidate the current assets to pay for the current liabilities. That's how you would pay for your current debt in bankruptcy. If the current ratio was 1, that would mean that current assets equal current liabilities. In a perfect world, what would happen? If the company went bankrupt, they'd turn all their current assets into cash, and then they would have just enough money to pay its current liabilities. All things being equal, you want the current ratio to be higher as opposed to lower. Is it unusual for a firm to have a current ratio less than 1? No, it's not. It's probably more typical for a firm to have a current ratio less than 1 than above 1. But if the current ratio was 0.6, for instance, that means in bankruptcy, you'd have 60 cents in current assets for every dollar you owe in current liabilities. Short-term indebtedness. Again, all things being equal, you'd rather the current ratio be greater. You'd rather have a current ratio of 0.6 than 0.2. And you'd rather have a current ratio of 4.2 rather than 2.2. Again, all things being equal, you'd like the current ratio to be higher instead of lower. The next liquidity ratio we're going to talk about now, this is known as the quick ratio, sometimes called the acid test ratio. And the quick ratio is defined as current assets minus inventory divided by current liabilities. In the assets section of a balance sheet now, current assets are listed from most liquid to least liquid. So if you look in the current assets section of a balance sheet, what's going to be the first current asset always listed? Cash. Liquidity means your ability to convert to cash at the lowest possible cost. How much does it cost to turn cash into cash? Nothing. Therefore, it's the most liquid current asset. If a company has excess cash, needs to invest cash, they're usually going to invest, put the money in a CD or a treasury bill or maybe a savings account, but something very liquid. Now, a treasury bill, for instance, or a CD, if you need the cash, you can always convert it back into cash, but there's going to be some cost to that. If you break your CD early, they're going to charge you a penalty for doing that. If you have a treasury bill and you want to sell it, the broker's going to charge you a fee for selling it. So those assets are very liquid. It doesn't cost much, but it does cost something to convert it to cash. Because of that, marketable securities is not as liquid as cash is. Accounts receivables, another common type of current asset. Now, accounts receivable means you've financed somebody's sale. You gave them credit. They came into your business, they brought all their stuff up to the cash register, and you rang it all up, and at the end of it now, they didn't pay you, they said charge it. That's a receivable. I was raised in a small business. If somebody did that, we'd write down everything that they bought, have them sign it, and then we'd put that piece of paper in a big drawer that was alphabetized. So if their last name started with a T, I'd put that paper in the T, behind the T tab. Now, at the end of the month, what did we do? We took out each section, sorted it out by customer, put it all together, and sent them a bill. Now, the accounts receivables on the balance sheet of my dad's business now was the sum of all that paper in the drawer. That's an accounts receivables. If you wanted to convert that into cash now, you would have to hire what's called a factoring company. And they'd come in, they'd study your clients, your customers, their kind of payment history, whatever, and they'd bid on the receivables. So if they said, we'll give you 60%, that means 40% of all the money, of all the receivables now is going to go to them in profit. You get the other 60%. So if the sum of all that paper was $100,000, they would have written us a check for $60,000, but the cost of converting those receivables to cash would be $40,000. That's pretty expensive. Accounts receivable is not a real liquid asset, okay? But indeed, it's a current asset. All those debts are due within the year. One of the least liquid assets on the balance sheet in the current asset section is inventory. Inventory is often misunderstood. If you go into a business and you go into their warehouse and you see all this inventory everywhere, to me, that's money. This is their cash sitting in there. You don't really want cash sitting in your warehouse. You want people buying stuff out in the front. Not only that, often there's stuff in the warehouse that you bought that you thought would be a good idea, And it turns out it wasn't. Nobody wanted to buy it. And so you put it on sale, you offer 80% off, whatever. But it's difficult to get rid of bad inventory. And if you're going bankrupt, what do people pay for your inventory? Virtually nothing, okay? So inventory is the least liquid current asset. And the quick ratio takes that out, okay? So if you take current assets and you subtract out inventory, what do you have left? Well, you have cash, securities, and receivables. Your most liquid current assets is what's left. And so you have your most liquid current assets in the numerator divided by your current debt, your current liabilities, your short-term indebtedness. Many people view this ratio, the quick ratio now, as a more stringent measure of liquidity, simply because it does what? It takes inventory out of the numerator. Again, if the quick ratio were 1, what does that mean? Well, you have enough cash, securities, and receivables to pay all the current debt of the company in bankruptcy. That's good. And all things being equal, what would you like this number to be? You'd like it to be higher relatively rather than lower. And again, you'd rather the quick ratio be 3 than 2. And you'd rather it be 0.8 than 0.4. All things being equal, you want the quick ratio to be as high as possible. The third measure of liquidity we're going to look at now, this is called working capital. And working capital is defined as current assets minus current liabilities. And the answer you get now is a dollar figure. All things being equal, again, you'd like this number to be what? Higher rather than lower. Now, a lot of people sometimes will calculate working capital and say, geez, the company has no working capital. It's 0. That's terrible. A 0 working capital means current assets are equal to current liabilities. That means the current ratio is what? 1. So you have to keep, when you look at dollar indicators as opposed to ratios, you have to remember what it is you're looking at a little bit sometimes. But all things being equal now, we'd rather working capital be a large positive number. Is it unusual to find working capital for a company to be a large negative number? No, it isn't. But again, you'd rather working capital be a negative 200,000 than a negative 600,000. And you'd rather it be a positive 5.6 million than a positive 1.5 million. Again, like all these liquidity indicators, you'd prefer this number to be greater as opposed to smaller.